Hey everyone. So today we're going to be looking at how management actually uses the reports that we've been looking at over this semester. So far we've looked at the balance sheet, we've looked at the income statement, and we've looked at the cash flow statement. And how management uses these accounting reports is going to be different to some external users. We know that banks will use them to evaluate the position of the business and how their cash flow is going, how liquid they are, how much profit they're turning over. But management has the chance to use these reports to understand how the business is functioning at a far more specific level. So today we're going to be analyzing how quickly we can move our inventory, how quickly we can turn our credit accounts into cash, and how we can benefit from perhaps delaying paying our own credit accounts. And hello, Lacey. So let's jump right in and have a look at it. So management has a day-to-day challenge, and that challenge is to be able to balance the continuous trading of inventory and turning that into cash. So in order for a business to be successful, we need to make sure that we're managing our inventory, our accounts receivable, and our accounts payable. By managing this core process, we can ensure success in the business. Inventory is the biggest major asset that a business can usually own. And as a result, we need to make sure that we're managing it appropriately. So we might need to figure out what goods should be sold, what quantities should be purchased, the markup that we should be offering. Is there any size range that we need to keep in particular if we're looking at things like clothes? How do we keep it safe from shoplifters? How long does it take for our inventory to sell? Are we trying to sell fresh goods, or are we trying to sell things like cars and white goods, which will often take a lot longer to turn over? And as a result, this is where the inventory turnover comes in. So the time that we take to turn our inventory over plays a major role in our success. Now, inventory turnover, it's going to vary from business to business depending on what we sell. As it says, a hot bread shop will have a faster turnover than auto spares business. And again, if you sell things like luxury cars, you'd be okay with a slow turnover because every single sale is going to be a massive cash injection. So we calculate it using the following formula. We have our average inventory times 365 because we want our answer in days, and then divided by cost of goods sold. So let's have a look at a quick example. Let's say that we start the year with our inventory at $24,000 and we finish with $28,000 at the end of the year. And our cost of goods sold over the year is $250,000. So we can actually calculate our turnover rate using that formula that I mentioned. So our average inventory is going to be $26,000, and then our turnover ends up being 38 days. Now, 38 days might be a really fantastic turnover, or it might be a really poor turnover. It depends on our benchmarks. Okay, so the benchmarks that we can use include looking at previous periods, looking at the expectations that management might have had, and above else, the type of inventory being sold should always be kept in mind. So if you're taking 38 days to sell a loaf of bread, I'd be very concerned. If you were taking 38 days to sell a Porsche or a Mercedes, you're probably looking very good. Now, a lot of businesses will sell on credit, and sound management of these accounts receivable is important because at the end of the day, the promise of cash isn't worth anything unless it is then turned into that cash. So we have to be collecting cash from our credit customers, but we can make this process easier or harder depending on what we do. So we have to decide who we're actually going to offer credit to, the credit terms that we'll offer, how much credit we'll offer, so how are we going to limit them, how do we get slow payers to actually speed up and settle their accounts, and are we going to offer any discounts for people who pay quickly? And if we are going to do that, what discounts are we going to offer? Because there's going to come a point where it's not viable anymore. And finally, we need to know how long it takes our accounts receivable to pay. So managing this process to help support the liquidity of the business is really vital. So just remember, there's little point in selling on credit if you're never going to collect the cash. You're essentially just giving stuff away for free. So as a result, we need to figure out the turnover of our accounts receivable as well. And our accounts receivable turnover, it's a really similar calculation, except instead of cost of sales, we're now looking at the net credit sales plus GST. We include GST there because we still have to collect that cash as well, because we do need to pay it to the government, regardless of whether or not our accounts receivable are paying us. So again, another example, if we had accounts receivable at the start of the year at $20,000, the end of the year it's $40,000, and our credit sales, excluding GST, is $400,000. So here's our formula. Our average accounts receivable is $30,000, and our credit sales plus GST is going to be $440,000. So our average turnover is 25 days. So if our terms are 30 days, we're probably doing very well. But if our terms are 10 days, probably not so much. Now, it's not just credit that we offer that we need to manage. We also need to manage the credit that we are offered by other businesses. So we also need to manage our accounts payable turnover. So from our perspective, we need to manage stretching this long enough so that our liquidity isn't affected, but also managing these relationships that we have, because these other businesses are in the same boat as us. They want us to pay as promptly as possible so they can manage their cash flow. And they want to be stretching out their credit terms that are offered to them as much as possible. Every single business is in this tug of war, constantly trying to stretch out their own accounts payable while force or coerce, encourage accounts receivable to pay more promptly. So things that we need to think about when we're looking for credit suppliers, we need to think who's offering the most generous terms. Because if they're offering more generous terms, they're not going to be upset if we take a little bit longer to pay. If they offer very strict terms and we don't meet those, it's going to affect our relationship. We also need to think about the quality of the goods they supply. We need to think about whether their prices are competitive, and we need to think about who's the most reliable when it comes to things like deliveries. Also, we need to think about, are they going to offer discounts to us if we do pay promptly? Now, as I've already stated, it's really important that we maintain really good relationships with our credit suppliers. So we can't abuse credit terms, because that's just going to limit our ability to trade with them, and it could also affect our reputation with other businesses. So it's important to maintain this. That's one of the reasons why we look for generous credit terms, so we can stretch it out as much as we can. Now, the accounts payable turnover, very similar to accounts receivable, except instead of sales, we're looking at credit purchases plus GST. So one more example. So at the start of the year, we have $10,000 on our accounts payable. End of the year, we have $14,000. And our credit purchases, excluding GST, is $150,000. So we do the calculation, and we find that we're taking 27 days on average to pay our accounts payable. So if this is within terms, they'd probably be very happy with us. If it's outside of the terms, then we're probably putting a strain on our relationship with that supplier. Now, the reason this is really important is because this all feeds into what we call the cash cycle. The cash cycle is calculated by your inventory turnover plus your accounts receivable turnover. That's the amount of time that it takes you to turn your inventory into cash, okay? Now, it's important to manage that, because we also have to think about our accounts payable turnover and having cash for them. A lot of people will also include inventory turnover plus accounts receivable minus accounts payable, because what we need to figure out is that how long can we stretch out our credit terms, and can we turn our inventory into cash before we need to pay our own suppliers? Now, most of the time, it's going to be really difficult to do that, depending on our turnovers. So as a result, we really need to try and balance this as we go on. It can be a real struggle for some businesses, and it's really the key and where a lot of risk lies within business. So if you can understand the turnovers that we've looked at and the importance of them and how to actually analyze them, you can begin to look at businesses in a whole new light. You can see the internal struggles that they have and the reasons they make different decisions that they do. And this is really applicable to the real world. So as we're going through, please make sure that you're taking the time to understand why you're making the calculations that you're making, and think about the entire case study that's offered to you in each question. It's really important to consider the type of inventory that you're trading, things like that. Okay? So I'll leave you guys with the wrap up of what questions you need to do, and I'll see you in class. Thanks. See ya. Hey baby, how are you? I know, I missed you too, but I have to do report and be home. Oh, look at this girl. She's so cute.